watching D Street this week, and my guest is Mahesh Patil, co-head equities at Birla Sun Life AMC. Mahesh, we were talking about sectors you like, and you'd mentioned the investment-related themes, and in particular power and cement. If we delve deeper into power, with the IPOs mostly planned around that, so NHPC is going to be an important one from the public sector. Adani already has closed on very impressive subscription levels. How do you make a case of valuing these, because visibility due to long gestation periods remains a question mark?
Yeah, I think clearly there has been a lot of excitement around the power sector. Clearly we know that there's a huge demand-supply deficit, which will last for many years, and there's a good investment opportunity. And the new IPOs have created excitement around the sector. I think when we look at power companies, we look at the existing listed companies as well as the new companies which are coming up, and then evaluate and see, how much you pay for the existing operations which are generating cash flows, and how much you pay for projects which are going to come down, say 2, 3 or 4, 5 years down the line. So I think one needs to have a trade-off on that, and give a premium to companies which are already generating cash flows and projects which are currently going to be executed in the near term, rather than projects which will be coming much farther down the line. So I think that trade-off is important, and that's what we look at when we are valuing some of these power stocks.
On the cyclical commodity space, which is interesting that you say you like that space, because many people are saying that, refining margins, for example, will continue to look depressed going forward. I know that you made a case for ferrous and non-ferrous, but in commodities, will you even include oil and gas at this stage? As well as a lot of the ferrous companies, including Tata Steel, have, chorus problems of fund and debt concerns related to them.
When I said commodities, it was essentially looking at the ferrous and non-ferrous. On the oil also, the outlook, probably oil would trade in a kind of a band around $60, and that's the view what one has. But in the commodities, we have seen demand actually coming in from China pretty strong. China GDP numbers in the last quarter, second quarter, surprised people. And that's given a hope that the demand recovery might begin, and a lot of plants which were shut down actually because of they were operating below the production cost should start now generating output. So I think it's more on the steel and the non-ferrous side is where I think we are positive. Again, these are sectors which are going to be volatile, so one needs to play tactically and really look at the short term as well as the long term when you are entering into the space.
When you talked about domestic consumption, Mahesh, autos and FMCG, would you say that in autos you would go with a consistent player like a Hero Honda, or would you go beyond to something like Tata Motors, which is coming in from a depressed environment because of funding concerns? And if FMCG, would you go to ITC, which clearly surprised the street, or would you go with HUL, where there is a little bit of an asset quality concern on the nature of core growth and the rise in expenses? How would you make that discrimination?
I think when you are playing the broad consumption theme, I think you wouldn't really put all eggs in one basket. We will tend to diversify. On the auto space, you will look at steady. I mean, Hero Honda has been a steady performer, and they are surprised consistently in the last few quarters, and most of it is already discounted. So I think opportunity lies in identifying companies where you could see a turnaround. Tata Motor fits the bill, where you're seeing it coming from a cyclical downturn and could surprise in terms of domestic volume numbers. International operations like JLR still remains a concern, and many people don't have a clear view on how that would really shape up. But clearly the risk definitely will be much larger in companies like Tata Motors, where there's some uncertainty because of the international operations. So I think one needs to have a balance of both steady performers as well as companies which are coming on from a downturn or probably could surprise positively going forward. Even in the FMCG space, both ITC and Unilever did disappoint a bit on the top line side, but by and large we have seen other FMCG companies coming up with good numbers and margin improvement. So I think these are steady performers, and they'll continue to do well going forward.
Just a quick comment, Mahesh, on the YTD performance of your fund, as well as, going forward, you believe that a very strong break-even, because 2008 was a very tumultuous year, will happen in the next several months. So we could not only be looking at higher levels, but maybe even a dash to the all-time highs in the next 8 months.
Well, I think difficult to really predict what the kind of returns will be for the next 1 year. But I think clearly there are 2 or 3 positive things which I think one is looking at. A, we have seen the liquidity being pretty good, domestic as well as international liquidity. So that will give support to the markets in any correction. We have seen earnings number coming in pretty good and chance of some upgrades going forward. Domestically, we are looking at reforms really, budget was a disappointment, but I think post that, we accept the reform process to continue, and that will give momentum to the growth as well as improve investor confidence. So by and large, we are looking at a outlook on the market from a medium to long-term view remains positive and maintain that.
All right, Mahesh Patil, great having you on the show with me. Thanks very much indeed for sharing some of those insights into how you read the situation going forward. As Mahesh pointed out, certain themes that he's particularly keen on include domestic consumption, investment related, and from the commodity cyclical pack, the ferrous and the non-ferrous space. But for now, we've been harping about the earnings positive surprise which has come in and really made the case for earnings upgrades going forward for the Sensex as well. Ashutosh Sharma joins me with the key look back into the Sensex 30. Ashu.
Yes, Namrata, if you look at the entire Sensex 30 companies, 27 companies have detailed their first quarter numbers, and results pretty much have been surprisingly largely in line or above expectations. The sales of Sensex companies has declined by 4.5% on a YoY basis, but on a quarter-on-quarter basis, it's actually gone up by 2%. PAT also coming in marginally high. If you look at the quarter-on-quarter figure, it's up 7% as far as quarter-on-quarter growth is concerned. So sequentially, it's better. 16 out of the 27 companies have declared results which are either above or in line with expectations, and most of these companies are in FMCG, IT, and the auto sector. We'll get to that. But EBITDA margins are also ahead of expectations. The consolidated margins for all companies, it's about 28% versus 26% also on a YoY basis. I was talking about the fact that IT, FMCG, and auto companies are the ones that have the earnings have been well above expectations coming in. And also the fact that Reliance Industries, ICICI Bank, and Sun Pharma, the numbers have been disappointing, so as to say, from these companies. But barring that, results have been pretty much surprising. Cement sector being the top performer as far as the quarter gone by.
All right, Ashu, interesting wrap there, and we will get you more detailed analysis all through NDTV Profit on that big cues and key comments coming in from the earnings season. For now, we leave D Street this week with the bulls clearly taking charge over the driving wheel. Will they steer to 5,000 or not is a question we'll answer next week. Thanks for watching. It's over to Bharat Iyer now with the latest headlines on Profit at 5.
That's right, we have a lot stored up, a lot of action coming in from corporate India. So we'll be back in just a second with that.
This is NDTV, and you're watching NDTV Profit.